So we're live now, so we got about a minute to chit chat before the official time. So when you get ready for the actual rate examples, just tell me which one you want
Okay, we'll
first.
flip them out. Yeah.
Yeah. Yeah, not too much reflection, right? It's reflection. Such is life. It's horrible being old. Well,
I
not
know.
horrible
I'm
being
catching
old.
up to you.
It's horrible having to wear reading glasses. I'll put it that way. But then
Oh,
again, I've been wearing
I mean,
reading
they're
glasses
always
for the
on top of my
last
head
20
if I can find
years. Roger that. Well, it's 11 a.m., everybody. So here we are live. And my guest today is Lisa Stepp with MPire Mortgage. Well, I don't know why I keep saying MPire Mortgage. It's MPire Financial.
them. MPire
But
Financial.
she is my go-to person on mortgages. And I wanted to talk with her today about the loan level buy down program. And what is the initials for that? LLPA or
LLPA is a loan level price adjustment that most mortgage professionals understand. Not kind of common every day, but it's how we price a mortgage when we're working on a product for a consumer. So
Mhm.
different programs require different things, loan to value, and it gets kind of fairly complicated when you look at a rate sheet, and it may be 15 pages long. But the computer systems do most of it for us. But
Okay.
today we want to talk about a temporary buy down in the rate, and there's terms anywhere from 12 months to 36 months, and it's a great way to get people into a home where their mortgage payment is going to be significantly less depending on the time option they select. And basically how it works is you can either use, there's two different ways to accomplish a rate buy down, temporary rate buy down, and based on terms, but we can use seller credits, and we can generate an upfront fee as to what that interest is going to be over the term of that buy down, and the seller can pay for that. Or, and not every lender will offer this program. So, and just because one lender doesn't mean this other lender is going to offer the same kind of, they're similar, but not always the same because everybody can add their own spin to it. And the second option, other than using seller credits, is to use the rate and something the lender would offer. Like right now, for our sellers, people that are listing their home for sale, if they need a new mortgage, we have a lender that is going to give us a free 1-year buy down. And we'll talk about that in a little bit. So we can actually use the lender or a loan level price adjustment to cover the buy down cost, to get this temporary rate reduction. And any borrowers who have seller concessions or would like to have a lower interest rate in the beginning of their mortgage for a lower payment, it's available, but you must qualify for the higher note rate. So today's example, rate of 7%. Depending on what buy down you take, could be a 3-2-1. We could take 3% off. And we've got some slides that'll kind of walk you through that. It's a little easier to understand once you can actually see it. But there's a lot of great benefits to using a temporary buy down, because it can help sellers get their home sold. And what that means is, say if a home is sitting there and the sales price is 300,000, not had a lot of activity. So they're like, oh, let's go ahead and reduce the price, 10, 15,000, whatever number they want. But instead of taking that price reduction, they can actually advertise that, hey, we will go ahead and pay your seller, we'll pay for your buy down. And the seller, that would go on the closing disclosure, and it is something that the borrower can take advantage of and not cost them anything. So that's a great option. But a lot of people, it looks fairly complicated, but you're going to see today that it actually really isn't. And if there's any excess seller credits, we can use that to pay for a buy down. And it'll lower the interest rate for the first 1 to 3 years, allowing the borrower to have that lower monthly payment. So if someone's in a rental situation and they're going into a new mortgage and the rate's going up, it can help ease that burden a little bit of what that payment increase is going to be. Especially, it's great in a high interest rate environment. Those of us who've been around a long time, we've seen interest rates in the 12s, we've seen interest rates in the 3s. They're all over the place when we've got some longevity in this industry.
How about 17% under
Or
Carter? That was
17%
a
back in the early
humdinger.
80s, 17, 18%.
Uh,
But those
on this,
prices were a lot less back then.
yeah, that's a fact. On this example slide you got here on $350,000, interest rates right now are kind of around the 7% range. So that's the example slide you got. And so based on a $350,000 loan, at 7% interest, the normal payment for principal and interest would be $2,328.56 a month. So take us
That's
through
right.
how this is going to save you money. How much would it cost to get this? So this, what you were saying is, this would be a good incentive for the seller to offer to get the home sold. So take us through that.
Yep. So I just got to blow it up a little bit so I can see it. So in this example, this is a 3-2-1 buy down. There's actually 4 different types of buy down, but this is the one that has the longest longevity. So and it covers 3 years. So it's at 3-2-1 because the first year you're going to save 3% off the note rate, which is 7%. And you have to qualify for the payment at 7% with just principal and interest. We're not talking about adding in homeowners insurance. We're not talking about adding in any annual homeowner fees or anything. It's just pure principal and interest. And these are just examples. So on a loan amount of $350,000 at 7%, the first year, the payments would be at the 4% rate, or a payment of $1,670.95. That saves the borrower $657 and some change every month in the first 12 months. And then once we hit month 13, then the interest rate goes up to just a 2% saving, or 5%. That saves them $449. And then the third year, it jumps up to 6% because it's tiered 3-2-1. 7% minus 3 is 4, 2 is 5, 1 is 6. That saves them $230 a month. And then years 4 through 30, then the rate goes back to the note rate. So the annual savings over the first 3 years is $16,049. That's a huge savings. And it gives the buyer an opportunity in their new mortgage. If they buy in a higher rate environment, they may be able to refinance and take a lower rate. So it really, there's lots of benefits to the 3-2-1 buy down. And now I got this thing big. There we go. Okay, we're going to jump to parameters here. So not every loan product has an eligibility for a buy down. It's purchases only, and it's conventional financing, FHA, VA, and there's even a jumbo buy down if you're over your county median. Conventional allows for both primary and second homes, which is kind of exciting. FHA and VA programs only allow the primary residence. No USDA, which is a rural loan product, is available and doesn't offer buy downs. And there's 4 different buy down options. The one example we just showed is the 3-2-1 buy down, which covers 3 years. There's a 2-1 buy down, a 1-year buy down, and then just one year total. And that's a little confusing, but once you see the examples, it makes a lot more sense. And the next slide, and I don't know if you have this one here. Let me see if I can flip to it. it should be the next slide after parameters. Yeah, here is
Mm-hmm.
actually our buy down option. So it shows like on the 3-2-1 in the first year, you have a 3% lower rate, 2-1 in year four, you're at 4, year 4, you're at the full note rate. A 2-1 buy down, you take 2% off the first year, and then you're 1% at year 2, and year 3, you're at the full note rate. And then the 1-1 buy down, it covers 2 years, and the rate is just 1% lower. And then year 3, you're at the full note rate. And then the 1-0 is just 1% off. And that's the one where, we've got some lenders out there that are offering free for our sellers right now. So that's pretty exciting.
Okay,
And
now I
this
got a
slide,
question for you.
yep.
I hate to interrupt, but
No,
let's
go
go
ahead.
back to that example of 3 years. Over the 3 years, the buyer is going to save $16,049 in this example. And as you said, this is only an
It's
example
just an
because
example.
everybody is
Right.
going to be different.
Right.
Depends on your credit score and all kinds of stuff. But kind of an example, this is kind of what they could expect to save. Uh, if the seller funds this for them at closing, how much is it going to cost the seller typically for this 3-2-1 buy down we're talking about here?
We do have some slides as an example, but each situation is going to be a little bit different. And we've got some slides coming up that will actually show how the seller contributes to that, and it's towards the end. But on the next slide, when you go into a buy down, here's an example of the mortgage statement buy down. So we've got what the principal is, what the interest is. In this example, it does have escrow for taxes, insurance. And if you look at the other line, number 2, there's a credit of $407. That's the actual buy down credit. And then, what the total amount due is. And each month, as the mortgage statement comes out, it shows what that buy down savings is. So that's just an example of how the mortgage statement will come out. And then on the next slide, we've got an old slide in here where we're using 5% rates. And we were, when rates went to 5, we were all shocked. And then, we're all the way up to 7. But again, it just shows an example as to what the savings amount is going to be over the term of that buy down. So, and then we go through examples. We have the 3-2-1 buy down, a 2-1 buy down, and you can see there's still significant savings. Even at the 5% example, the savings over the first 2 years is more than $7,000. And then we have the 1-1 example. And, when we're not dealing with the same length of term, obviously the savings does come down. In our 1-1 example, where we've got 2 years of payment with a 1% reduction, it's just under a $5,000 savings using a 5% interest rate. And then the 1-0 example is just the first year they get a 1% buy down. That savings $2,496. So, the savings really do add up. And then here's our disclaimer. We're not talking about APRs, just an example of how the numbers work, etc. So now let's talk about really, if the seller is going to go ahead and pay for the buy down here, that you can use seller credits instead of the seller taking a price reduction on the home. They can leave that and just offer it up as a credit to cover the amount of the buy down charge. And when that happens on the LE and CD, let me flip to the example here. It'll show in box H. Oh, flipped one slide too many, and that's a little small for me to see. But we would have a temporary rate buy down, and the total fee in the example that we used is $12,335, and the seller
Mm-hmm.
will pay that. And it would be disclosed in the closing disclosures. And you can see there's nothing, that the borrower paid. So it's taking the proceeds from the sale of the home, and it title at closing will pull that money and it'll be shot right back to the lender. and it's held in an escrow account, and it subsidizes that mortgage payment monthly until the money runs out and the buy down is complete. And
Okay.
then the next slide we show, because there's two ways to accomplish the buy down, whether or not the seller is going to contribute and take care of it, or we have lender paid buy downs. So, and here's where the loan level price adjustments come in. And it doesn't really mean anything to the general public. It's just how the pricing works coming out of secondary markets. And you can see that, you know, the 3-2-1 buy down is the most expensive because it covers the length of term, and it goes through the example of you know, what the actual cost. And this is just one lender, doesn't mean everybody is the same. Just want to disclose that. It's just the example of what we're using today. And you can see as we move down to the lower terms, in terms of time, you know, those price adjustments become less. And again, a lot of
Okay.
time. Go ahead. What's your question?
On the 3-2-1 buy down there, I'm assuming that's 4.5 points on the
It's points,
LLPA.
not in rate. It's not rate, it's points.
So that is paid by the lender in this example?
It could,
Where's
we
that
could
money
use the
coming from?
rate. It's going to be in the pricing portal for each lender. So what that means, so we have a loan, we know what the FICO scores are, DTI, what the loan product is, you know, if they have any residual income, depending on the program, what is required. And then we go in and there's kind of buckets, if you will. You know, if a rate is 7%, you know, do they get credit because they have a really high FICO score? There's a zillion different things that impact that rate. And we just, you know, you may have 10 different adjustments, or you may have 4, but the loan level price adjustment is an adjustment that impacts the rate in points. So there's different ways to price, whether or not we're using rate for compensation or borrower paid compensation. All that becomes very specific, very overwhelming to a buyer. So that's where, you know, dealing with a mortgage professional that's been around a long time, knows what they're doing, you know, it becomes very overwhelming. And in old school, we would get rate sheets for the day, and typically they're released at 10 o'clock in the morning. And here's today's rate. And then you got to go, what's my FICO? What's my loan to value? You know, are there any state riders? And you just start kind of going down the list for what the loan level price adjustments are. And then things get added in, things get subtracted. There's credits and debits, and that's how we end up with our final rate. And that's really what the loan level price adjustments and how they come in. But just because we see a 4.5%, 4.5 and loan level price adjustment doesn't mean that that rate goes up 4.5%, or there's 4 points that come into the transaction. There's other credits that can offset that along the way. And it's based on each individual loan. FICO scores, DTI state, purchase, et cetera, loan to value, how much money you're putting down, et cetera. So it can be pretty overwhelming, but the systems do it all for us. And then in our next slide, go
Getting to
ahead.
the next slide, I did have another question pop in
Yep.
there. As I understood you, this covers pretty much all the programs except for the
USDA.
USDA. Thank you.
And it's
I hate it when
purchase
I get a mental
only.
block.
Yeah,
Okay.
can't do it on a refinance. It's
No
just purchase
refi, but
only. And second homes are
so,
included with conventional financing as well.
but my point in asking that question is you don't necessarily need 20% down on these other programs. So if you only
That
had,
is
say,
correct.
5% down, this would still be advantageous for the buyer.
Absolutely. Yeah. Because in our
Okay.
examples, we're just using pure principal and interest. But, you know, other monthly allocations that would come in would be, you know, if you're not putting 20% down, you may have a PMI payment coming in, as well as your tax and homeowners insurance escrows. So we don't want to make it confusing. So we're just using principal and interest only in our examples. And again, anytime there is a buy down charge, it is fully disclosed. Section H of the LE as well as the CD. Okay. And when you do get into a buy down at closing, there's actually a buy down agreement that comes in that's 2 pages that explains everything, how the payments, amortizations, and that is actually signed at closing. And if it's going in at disclosure, it'll be signed at the original.
Okay.
Okay.
Well, that wasn't as painful as I thought it might be. I hadn't really looked into the buy down program. Honestly, I knew it existed, but tell me about this special program one of your lenders has come up with right now.
Yeah. So, we have potentially a big change coming to the market next week due to a class action lawsuit from the National Association of Realtors. And we're not quite sure how it's going to impact all of us in the real estate world that, all of us professionals, we still need to earn money. So we've got a big national lender, and it's common and customary for different programs to be launched throughout the year. May is Big Military Month. That's another example where, lenders will offer, any VA financing, maybe there's a savings to the interest rate, or, they'll give us something. So I've got a lender right now for any seller that is listing their home. And if they need to go get pre-approved for their next mortgage purchase, they have the opportunity to take a 1-year buy down free from the lender. And that can be substantial savings depending on that loan size. So those are just different examples. And MPire Financial is one of the fastest growing brokers in the United States. We do a lot of business. And so we always get, someone's always throwing us something to make sure we continue to use that lender, because I have 85 lenders to choose from. So that's exciting and overwhelming all at the same time.
So this program you have right now is specifically for new sellers that are wanting to list their home, and they're going to need a mortgage on whatever they buy to replace where they're at now.
Absolutely.
But it should be pretty advantageous for them, because most people that have a home already are going to be in a pretty good position in terms of equity because of the big increase in homes, prices over the last couple of years. So most of those folks should be over 20% down payment, so less than 80% loan to value. They're not going to need primary mortgage insurance. How much does PMI usually run a month? Typically, $200-300 a month.
It's a factor. It's a factor based on from the different MI companies that are out there. Your FICO score, DTI, all that comes into play. So I don't really have a number I can spit out, like FHA's 0.55 factor. But for all the other conventional PMIs, they're all over the place. So yeah. So it's not, I don't have.
Let me rephrase my question. It would not be unusual for PMI to be $200-300 a month.
No, not at all. No. And those
what's
factors,
a higher one you've seen recently?
I've seen it in the 200s. It has been the highest one I've seen, lately. But again, it's based specific on that borrower. FICO scores, down payment, etc. So it's not just cookie cutter that everyone just gets this factor. It's kind of like a loan level price adjustment, right? The higher the FICO, the bigger the down payment, the better rate, the better loan level pricing adjustments, if there are any. And they'll start giving credit at that point. So, yeah.
So, yeah, and this is why I talked to you, because I am not a mortgage expert, but I just had a little bit of an epiphany there. The loan level price adjustment includes a lot of different factors, like PMI, buy downs, and whatever. So I was kind of thinking that the LLPA was just associated with buy downs. So there you go. I learned a little bit more. I learn a little bit every time I talk to you. So you keep educating me, and I just might run you out of the mortgage business. That's a little humor.
Say loan
I got a lot of education.
I can remember when it was like 2008, 9, 10, when we came through the mortgage meltdown. All these loan level price adjustments came in, and a lot of them are tied to the financial market. So not that I really want to spend a great deal amount of time talking about capital markets, and that's really what controls. I mean, when you're talking about mortgage pricing, There's a whole division that takes care of that. It's based on the
Mm.
economy, how that lender operates. Do they service their own mortgage? Do they sell in the secondary market? A lot of times, I'll get an email and just say, hey, we've got a special, like say a big nationwide lender is sitting on a couple $1 million worth of mortgages and it's in their portfolio. Now they want to package it together and sell it on Wall Street. And maybe they're short because maybe an equity firm says, you know what, I'll buy this from you, but I want to buy 3 million. So they'll send out to us, hey, I've got special rates for this very specific bucket. I want a mortgage size of this, I want a FICO score of that, blah, 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 blah. And boy, we can grab a lower rate. Those things happen all the time. Most of the time they're not well talked about, but we can see it daily when we're pricing mortgages out for our clients. Some lenders had this happen recently. Had a VA client that didn't know how much money they were going to put down because their current home hadn't sold yet. So we went very conservative, and we started pricing out, well, okay, if you put up to 20% down, here's your rate. If you put more than that, this lender jacked up the rate. I'm like, well, that's the craziest thing I've seen in a long time. But it depends on each. That's why I went to the broker world. That's why I like it, because it gives me so much more opportunity to help my clients. I'm a consumer too. I want the best rate and the best options available to me. And that's why I have this large pool of lenders to select from. Each one has their own nuances. Some are very quick. We went from clear to close in like 6 days in the last month. So it depends on kind of what that client needs based on conversations. That's how I kind of pick my lender. If it's cookie cutter, who's got the best rate and the best service out there? So service is more important to me than rate. If I know I can make up a phone call and just say, hey, I need to move, we need to get to the closing table. We have to close tomorrow. Who's going to help me jump through hoops? Because that happens all the time. Something gets delayed. Maybe the appraiser took a little bit more time than anticipated, but we have a contract. We've got a closing date. We got moving trucks coming. We need to make that happen. So who are my go-to lenders that are my partners, and they'll make that happen for me. So
Now,
you pick and
I kind of
choose
got
your
you
battle.
sidetracked there. Roger that. I kind of got you sidetracked when I got
Yeah.
off on the LLPA question. But I
Yeah.
do want to get back to the special program you're offering for just a minute. So
Yep.
it's for people that want to list and they're going to need a mortgage to buy their next home that they move into. And the buy down is for them moving into their next
New
home,
property. Right. Right.
right? And is it a 1-1, a 1-0? Which is it?
It's a 1-0. We may have the option of a 1-1 as well.
Okay, so on the 1-0, they get a 1 point buy down for the first year,
Yes.
and or
And a
1% buy down, I guess is a better way. I
1%
should
buy
have said
down.
that.
So if their
And
current
then,
rate is 7%, it'd be 6% for 1 year.
mhm,
But we may have an opportunity to grab a 1-1, and that 1-1 gives them that 1% over 2 years.
mhm.
So
And if they wanted to take advantage of this program, is there the possibility that they could pay the difference in the fee and get like a 2-1 or a 3-2-1?
absolutely, anything is absolutely possible when we're talking about buy downs. And if and that's where the complexity comes in with FICO score, DTI. And when we price it out, we can see what and yesterday, me and my colleague out of Texas, we were running different scenarios. He's like, okay, this is what I got. This is what I got. What's the pricing? What's the difference between the 4 different programs? Does it impact rate? Does it impact points? Does the consumer need more money down? We were comparing and contrasting all of those different examples, but it
Mhm,
changes specifically to that borrower. So like for
mhm,
me, my conversation, like if I was talking to my client and entertaining buy downs, what's the difference between, okay, here's our free one, this is what your savings is going to be, here's the 2-year buy down, and then if we want to look at the 2-1 or the 3-2-1, how does that impact rate, fees, etc.? So I
Mhm.
always like to give my borrowers 3 different options, to say, and here's what it would cost, and we give that to them in writing.
But the
And
question I was driving at there then was, though, if a listing client took advantage of your 1-0 program that you're offering right now, they would be able to take advantage of that and just pay the difference to get either a 1-1 or a
yes,
2-1 or
yeah,
a 3-2-1.
right.
So they wouldn't be giving up anything
Wouldn't be
if
giving
they
up anything.
wanted to extend it on out to a different one. And
Right.
another thing you and I both need to be careful about is industry jargon. I heard you go
Yes.
through there with DTI, which a lot of
Is
people
debt to income
might not,
ratio.
debt,
Mhm.
debt to income ratio. So, it's like when back in the day when I was a pilot, and we're getting way off in the weeds here, but I'll just talk just very briefly. We're about ready to wrap up here, so allow me to go back to my old flying days. I was at a what we called a FBO, or fixed base operator. I flew corporate jets, and I was telling the lady behind the counter that I needed a mechanic to bring a nitrogen cylinder out to the aircraft to recharge an accumulator. And one of the although I don't think I actually mentioned nitrogen cylinder. I just said I needed an accumulator recharged. And one of the other pilots happened to be standing there, and he said, "She has no idea what you're talking about." So, yeah, and I just at that point said, "Send a mechanic out with a nitrogen cylinder, and I'll be good."
Right,
So,
right.
that's what we got to be careful about, is being accustomed to the terminology. Not everybody outside the industry is going to know
Yep.
that. But I do appreciate your time this morning, and I think
You're
this
very
is going to be a
welcome.
great program. And I hope you have a good day and a happy 4th of July. And I'll
Same to
talk with you
you.
next week sometime.
Okay, sounds great. Thanks, Ed.
Thank you so much.